Dearborn&Creggs. And today, like Jana mentioned, we want to bring you Tina Downing. Tina is our Senior Director for the Business and Portfolio Consulting Group. And in this role, she delivers strategic business planning, ongoing consulting to investment advisors across the US and Canada. But more specifically today, Tina is going to discuss the very important component of being a successful investor, and that's really on behaviors. Client behavior can have a huge driver of investment return, but it can also be a big risk, and it can take those returns away. Today, Tina is going to share some thoughts that can help you be a better investor during choppy times in the market. And with that, Tina, I'll pass it over to you.
Great. Thank you so much, George. I'm really thrilled to be with all of you today. And this kind of brings me back to the days that I was a financial advisor myself for many, many years and working with the clients, to help them, especially when markets got a little bit chaotic and volatility set in. And we may be seeing some of that, this year, and we have already a little bit. But how do we really look at what's going on around us and make sure, as Jana said, that we're making good rational decisions about the long-term health of our wealth over time? But I have to tell you, being a good human investor sometimes is tough. Every day we're faced with turning on the radio or turning on the news and hearing all of this information coming at us. And how do we actually assimilate that information and understand exactly what has to do with us, especially at a time when there's some news, there's some commentary, there's some opinion, and how do you actually decipher it all to help make sure that you're making good decisions and working with your advisor very, very closely to monitor your plan, make changes as needed, and making sure that emotions don't take over when making those decisions. And it's equally as hard for advisors too. We actually go through some of these same emotions as we're thinking about our own investments and the recommendations that we make for all of you. And as we think about that, we know that there's this roller coaster of emotions that we see in the industry. So when you start working with your advisor, we're usually pretty optimistic about what the outcomes are going to be. And the last 10, 15 years, it's been great. You get there, you put your money in and start making money. And what we see as the markets stay positive for a long, long time, we see this state of excitement and thrill and euphoria that gets in the market. We see that specifically, Jana talked about, Bitcoin and gaming. And, back when I was an advisor, it was, around credit or technology. There was a lot of excitement and people want in when things are going up. People want to be making that money. They have this fear of missing out. And as things are going well, we begin to expect excess returns. We know if we look historically, we can look back to see what average returns are. But when we go into the markets during a period of high performance, we start to expect those excess returns. And then when something happens, we're going up at this wave here and we're at this euphoria state, what your advisor knows and what they work with you on your own portfolios is thinking about now with everybody so euphoric about the market, that's probably at the point that we're at the maximum financial risk and what needs to happen and what do we need to get in front of. And then all of a sudden something happens like the week of March the 23rd of 2020, when we saw everything locked down and the markets plummeted during that time. It looked just like this wave here that you see. People started having anxiety about their statements. You may have opened your statement in February and it looked great, because we're at the highest point of the S&P on February the 19th. And then all of a sudden, the week of March 23rd, you open your statement or at the end of the month and it may not have looked as rosy as it was then. So there's this anxiety and fear and sometimes panic sets in. And then all of a sudden, when we start to think that the markets are never going to rebound and what are we going to do? Fortunately, that was a very short time for us in March, but I've seen periods within the 30-something years I've been in the business that those times were a lot farther, apart when the recovery happened. And a lot of clients, we even saw this that week of March the 23rd, 335 billion to be exact, left the markets and passive funds and ETFs actually left the markets that week. 335 billion that got to this people that got to this state of despondency of I just can't take it anymore and I don't want to risk any of my money anymore. Jana talked about having this fear of losing money. that's the reality. And when you pull the trigger here, a lot of times, we have this fear of actually taking true loss, because the pain of the loss is actually felt twice as strong as the pleasure of a gain. And that's based on a study that really looked at human behavior as it relates to investing. Now, what we do also know that during this roller coaster of emotions that we see in the markets that go along with market volatility, right about the time that those 335 billion in assets are actually leaving the markets, that's the time that we know that has the most opportunity for gain in the past, in the future. So then we see that cycle happen over and over and over again. And if we know that, what do? That's why your advisor talks a lot about staying invested, that time in the market is more important than timing in the market. We're going to talk about that a little bit in going forward. But as we're thinking about those behaviors and what really drives us to make these emotional decisions about our money is key. And so today we're actually going to talk about three things. We're going to talk about what makes humans human, a little bit of the science behind, in investor behavior. And we're going to talk about common behaviors that we see. Now, when we think about behaviors and investor biases, based on all the studies there's over 200 different biases that we actually have internally and we don't have all of them, but we have them based on past experiences, people maybe you've worked with in the past, decisions that you've made that haven't turned out right. So sometimes these past experiences and views, and even sometimes how we're raised about money, creates these biases about how we make decisions around money. And we're going to talk about those common behaviors that those biases cause over time. And then we'll talk about the value of working with your advisor and the things that maybe you need to talk to them about, things that maybe can give you a signal that maybe I'm not making a fact-based decision. Maybe this is an emotional decision, and maybe I should reach out to my advisor to think about this. So what makes humans human? Well, the brain is this amazing thing, is unbelievable. It's an incredible organ that allows us to recognize people that we haven't seen over the years. I was in the car the other day and a song came on. It was Cats in the Cradle. I don't know if any of you know the song, but all of a sudden I started blaring out, thank goodness I was by myself, blaring out the words to this song. And I literally haven't heard, I knew every word to the song, and I hadn't heard that song in over 20 years. That's the beauty of our brain, and it stores back this information, and it's unbelievable because it processes over 11 million bits of information every single second, and that those little bits of information hit our brain. Our brain then filters it down to the 40 most relevant at that time, and then is able to retain in short-term memory only about 7 of the most relevant pieces of information. And it does this totally subconsciously. We don't even know is going on. And it's really this incredible ally in human development because it allows us to think differently. It really is what separates us from all other species out there. But sometimes our brain leads us to answer the wrong questions. Sometimes it leads us to come up with an answer to a question, but then not really understand what the question really is. It also sometimes can desert us altogether and just shut down. So as we're working through that, we know that there's actually 2 different parts of the brain when it comes to investing. There's the blink part of the brain. That's that part of the brain that prompts us when you see this wolf in the woods, that makes us automatically have this visceral reaction to run. And I would do that. You might fight or you might freeze, but I know my inclination would be to run. It doesn't, that blink part of the brain doesn't actually analyze a situation. I wonder how far away the wolf is. Do you think I can get to the tree, before they can get to me? It doesn't do any of that. It doesn't calculate probabilities of it getting to you, before you get to the tree. It doesn't weigh pros and cons. It simply prompts us to run away. It's what we call survival instinct. And this part of the brain is sort of this quick and dirty kind of satisfying system because we make thousands of decisions every single day. And it tries to give us answers that are not precisely correct, but approximately correct. Now think about the decisions you make. Maybe you go somewhere for lunch and you've never been there before, and that's a decision that you made and it was a really bad lunch. That's not a life-altering decision. So this blink part of the brain, it doesn't matter if a lot of these questions are totally answered correctly. But when the blink part of the brain plays a part in the investing, if you allow it to take over, sometimes it can make dire decisions about the health of your wealth over time. The other part of the brain is that thinking part of the brain. It is that rational, more reflective part, the ones that helps us that comes into play when we have to solve complex problems. When we're calculating, things that are complex, or we're working on difficult situations that have a lot of moving parts, is analytical, is thoughtful, is logical. And it really attempts to actually follow this deductive logical approach to problem solving. However, it can only handle one step at a time. And so it's a slower way of dealing with information, and it requires a deliberate effort to actually engage this system. Now, we actually need both parts of the brain, the blink part and the thinking part of the brain. We need both of them and generally it's a good system. There's this symbiotic relationship that one kicks in versus the other, although that thinking part, when things get stressful, you have to actually engage it. That blink part of the brain is on all the time. It never turns off. Now, it's usually pretty accurate, the blink part. It usually makes good decisions. It chooses appropriate initial reactions to things. It responds quickly, but it does have biases that sometimes make us make these emotional decisions. And the blink part of the brain doesn't take time to build in logic and empirical evidence and history and think about the methodical steps that you really should go through as you're thinking about making investment decisions. Now, traditional finance, because I know a lot of people that are up, in portfolio management roles that are managing billions and billions of dollars, that are traditional finance people. Traditional finance doesn't take actual behavior into play. Traditional finance actually assumes that all investors are rational, that we come at things in a very logical way, that we're able to deduce whatever statistics and information that are given to us. This is why your financial advisor is so important, because they're trained during their process to actually understand some of these things about how the behaviors actually link with outcomes for the investments, so they can overload all the great work that these brilliant portfolio managers are doing to what it actually means for you and your outcome. Now, as you think about this long term, what are some of the behaviors? The ones that we see most common, there's 3 of them that we see all the time. One is overconfidence, and we'll talk about what all of these means in more depth. The other one is hurting. Jana talked about this one a little bit. Jana also talked about loss aversion. We will actually, fit that in even more within the overconfidence area as well. And then there's familiarity. Now, all of these I've seen throughout my entire career, see them every single day. Let's start with overconfidence. What is overconfidence? Well, let's take a typical situation. And let me just ask you a quick question. Now, in the question is, and you don't have to worry about answering. If you want to put it, actually, if you have a way, if you're watching and you have a way to type it in, put your answer in Q&A, that's totally fine. But the question is, if I would ask each one of you, compared to other drivers when you're on the road, would you consider yourself an above average driver, an average driver, or a below average driver? So if you were thinking about you and your driving skills, are you above average driver, an average driver, a below average driver? Of course, I told my husband that I actually had answered this question when I first heard this presentation, and I answered that I was an above average driver. Now, I don't know if you know the old cartoon Mr. Magoo. Oh, Janice says she's naturally an above average driver. Of course, that's what I thought too. And Americans usually do think that we are, not just Americans. I'll show you the study in Sweden too, but we all think a lot of times that we're an above average driver. And when I told my husband, of course, I answered that I was an above average driver. He told me that you drive, Tina, like Mr. Magoo. You remember Mr. Magoo, if you're old enough to know that old cartoon, he was driving, everything was great in front of him, and he was leaving this wake behind him of accidents, and all these things happen. My husband swears that that's me. I don't know what he's talking about. He must not be in the car with me. We must not be in the same call. So as we think about us as drivers, there was actually a study done by AAA. AAA study went out and asked the same question to all of their members. And 73% of US drivers actually considered themselves to be an above average driver. Now, despite the fact that more than 90% of all crashes are actually the result of human error. Now, something doesn't compute there. Now, apparently, for the women that are on the phone, men in particular are confident in their driving skills. 8 in 10 men consider their driving skills to be better than average. This overconfidence in our driving abilities is not a US phenomenon at all. I mentioned Sweden before. 90% of the drivers in Sweden rank themselves as better than average drivers. Now, where does this overconfidence actually stem from? Humans tend to overestimate our skills, especially when we've done something for a long time. We tend to underestimate the risks that are involved, and we exaggerate our ability to actually control those risks over time. What does it look like? This is driving, but what does it actually look like when we talk about investing? Investing, overconfidence sometimes translates into trading more. You could have higher portfolio turnover and buying and selling. Overconfidence leads to that sometimes. Overconfidence also may make us sell too quickly because we are sure of what the market's going to do, or we're sure about what the stock's going to do, or a fund's going to do. And sometimes we tend to assume that we know more about what's going on than we've really done the research around, because of the feeling of overconfidence. And we also might tend to take more risk the more overconfident that we are. We see this a lot of times in the gambling world. Overconfidence, sometimes you double down on your money. We see it all the time there. Now, there was a study done that I'm sharing with you on the screen here. And the study was that this researcher, they were 2 University of California professors, Brad Barber and Terrence Orden, and they actually delved into this big time. They analyzed the activity of 78,000 households of a large discount brokerage firm. And when they looked at the trading categories, they divided the clients into 5 different categories. The top 20% of the clients were the ones that had the lowest turnover, or that had bought and sold the least within the portfolio, at around about 2.4%. And then the next group, the 20, was the next 20%, and each group, represented 20% of the people, the 78,000 people. The group 5 was the last 20% of the group of people that had the highest turnover, and that was actually a huge range, anywhere from 2.4 on the lowest end to 250% turnover on the high end. And what they found was, over time, that over a 10, 15-year period, all 5 groups actually earned the same gross rate of return of about 18%. But when they truly looked at what the net return was, that they found that the higher turnover portfolios actually performed worse at about 6%. Now, why is that? It's because of cost, it's because of taxes, it's because of making the wrong decision, not getting in at the right time and trying to time the markets too much. It really did affect the turnover at this time. They also were intrigued by who actually did the turnover. Men Single men actually had more turnover at about 85% turnover every year on their accounts. Married men, about 73%. We all know why the married men did less than the others, because if you look at the married women's turnover ratio, it was 53%. So what does this actually mean for you and your spouse? Make sure you're both involved in the decision making, because you may not have the same risk tolerance. You may not be comfortable seeing the same swings in the markets. You may have different priorities for that money and need a safe haven in some of it. You may need growth in other parts, and being able to work together and bringing both of you together to meet with the advisor so they understand both of your priorities and understanding how you actually view risk differently. It has higher implications by trying to take on that overconfidence and being too confident without actually doing the research. It's the beauty of having an advisor work on your behalf every single day, day after day. As you're thinking about these endpoints, pulses of, I think I know what's going on here, I need to know this, check in with your advisor. Talk about what you're thinking of doing. If you're going to take on something that's more risky and you're not a risky person, make sure you're not doing it with a big chunk of money, because that could have major negative impact on your investments over time. Make sure that your essential expenses are covered. Make sure your contingency expenses are covered, and planning for what might happen in your life before you become overconfident in all of the things that you're doing, trying to make quicker money in the markets. The next behavioral mistake is familiarity. Actually, this one's hurting. It's not familiarity. The last one is familiarity. This one is hurting. Why do we call this hurting? Well, let's look at a couple fads that have actually happened over the years. Now, most of you probably know what this little red thing is on the left-hand side. This is a fidget spinner. Now, these came into play, I guess, back in 2017. The fidget spinner was actually initially developed for ADHD kids or kids with autism to help them actually focus while they were trying to learn. It was this thing that you held the middle of it and had ball bearings in it. You would spin it. You got a really good one. There was one made in China that could literally spin for 12 minutes. This actually became one of the biggest fads in the history of toys. It wasn't initially a toy, but it became one of the biggest fads. It came out in February of 2007, and by May of that year, it was in the 20 top selling toys on Amazon and within the 17% percentile of all toys sold everywhere. It actually literally took 3 weeks for it to cross the Atlantic and go global. Within 6 months, there was 19 million of them sold in America and in Europe during that first 6 months. People wanted them. You could get them almost everywhere. Everyone was giving them to you if you were doing business with them. If you look at the other fad, this is one of my favorites, because I probably, back in 2002, was one of the first Croc owners ever. But remember, they didn't look like this then. They were those black, ugly Crocs. They still have those, and I still have my pair. But it really does go to the fact of what fads and the fear of missing out actually does for us. I was one of the first owners of the black Croc, but I remember the first time I tried to leave the house, my husband was like, "You're not leaving the house in those things. Those are like, plastic bedroom shoes. You can't go out in those." Now, 15, 20, this many years later, it's the norm. Today, I wear my pink camouflage, Crocs out to dinner on a Friday night, just like I would a pair of Jimmy Choos. So what does that actually mean for us? When these fads start happening, we're all social people. We want to be part of something bigger than just ourselves. That's why social media is so popular. We also have these perceived safety in numbers. That's why I can actually wear my Crocs today out for dinner when I wouldn't have dare worn them, back in 2002. We also have this fear of missing out on something great and something that will be really good for us. How does that actually equate to the market? We saw this happen during the tech bubble. I remember as an advisor, I had clients that were my most conservative clients calling, wanting me to put a majority of their money in technology. And we had technology exposure because we had a balanced portfolio. But when everyone sees the money that people are making, we see it with Bitcoin now, we see it with gaming now. How do we actually look to see if this is something really appropriate for us? Because we also experience that tech bubble bursting of what actually happens and what actually happens to the flow of money in these areas. As you're thinking about trying to go along with where the trends are, that hot dot is not necessarily where we want our money today. There may be exposure that you have, but depending on what you want your outcomes to be, how long you have to invest, what your risk tolerance really is, and risk means something differently to every single person. There is risk in having too much exposure in one area. Diversification is key. And trying not to time the markets is also the key, and not chasing that performance. Because if you look over time, you can see during this time period is between 1984 and 2019. The number today, I just looked at the numbers here. We've just updated this slide on one of our new presentations. The numbers are actually even bigger now. But between 1984 and 2019, clients that had actually tried to chase that performance and try to time the market actually did an average of 8.88% in return. For clients that had a plan, stayed in the plan, and looked at a long-term view, actually earned about 11.05. That's a difference of 2.17%. As of the numbers at the end of last year, it was at the end of 2021, it was 2.37%. Over time in the market weighs out and wins out over timing of the market. So as you're starting to think about, maybe I want to get into this type of investment, reach out to your advisor, talk about if it really is in line with what your needs are, with what your outcome expectations are, of what time you have to actually stay invested in something like this. And when you're actually going to have a plan that you're not going to actually hold this stock anymore if it doesn't do what you need it to do, or this investment that you need it to do. This is the beauty of having a financial advisor as well. The third behavior mistake that we see all the time is familiarity. Now, I think back to one of my most recent trips to the grocery store. I don't know how this happened, but I am the one that goes to the grocery store for the family. I didn't used to be, but my husband hasn't been to the grocery store in probably 5 years, except maybe to pick up a 6-pack of beer here and there. But now he gives me this list of things that he wants, and he needed a bottle of Head and Shoulders. I needed some Cheerios anyway, so I was like, okay, I'll go. And I went to the grocery store, and I really started looking around for him, because it's hard for me to shop for him. I don't know why, it just is. But I looked at the Head and Shoulders, and there were like 10 different types of Head and Shoulders. And I looked at it and I thought, okay, that's a lot of choices. But I had just come from the Cheerio aisle, and there were 25 different types of Cheerios in my grocery store. And as you start thinking about it, we as consumers demand that we want choices. But what did I do? I defaulted to plain old Head and Shoulders and the Cheerios that I grew up on, that I knew for my entire life. I did not venture out. So we say we want choices, but we get easily overwhelmed, and then we go back to what we know. We go back to those things that we're familiar with, and we're biased by what we think we know. An example of this, when you're thinking about your investments, is how you're actually invested globally or within the US, because I think this actually shows it probably better than anything. If you look at the US market capitalization of everything within the global economy, the US represents about 59%. But if you look at the home country allocation in our investment portfolios overall, is 87%, even though we represent 59% of the globalized markets. Now, you would think that, okay, it's America. That's why, because, everybody wants to buy American. But if you look at Japan, they represent 7% of the market capitalization, and their home country allocation, or their investors wanting to invest in Japan, is 91%. The same with France at 3% of the capitalization, and 79% of the investors want to invest in France. The same with Germany at 72%. We like to stick with what we know. Now, what does this actually mean for you and your portfolios? You may have a stock that you wanted to hold on forever. You may have a concentrated position that represents a lot of your investments, and you're tied to that because you had loyalty to it. Maybe it helps you build the wealth that you have. But how do you actually think about that and the risk that's there? I'll give you an example of a client that I worked with. He was an executive at a very big, very respected firm. And over time, as we started working on his investment plan, he really wanted to stay about 75% in that stock. And I was really worried about having that much in one stock. And we worked over time because he did realize the risk involved in that. We started working out of that stock and diversifying it. That's the key here, is to have diversification and global diversification, because there's so many firms now that are not just US firms, there's global firms. So how do you really think about that from his perspective? We moved out of this stock and we literally only had 10% of his portfolio left there. 6 months later, once we moved out of the rest of that stock, and we had to do it over time because of taxes and a lot of considerations to do it the right way, 6 months later, that stock was out of business. That stock was Enron. So as you're thinking about your portfolios, what you have, are you diversified? When your advisor calls to say, hey, I'm worried about this allocation, I'm worried about us having too much here, that's why. Because as you start to look at that market capitalization, what it means for your outcomes over time, understanding that rebalancing matters, asset allocation matters, and diversifying the assets over time matters. Now, I want to stop here. I see a question here in the Q&A section here. So the question is, thank you so much for putting this in there. It says, how do I know what questions I should actually ask my advisor as it relates to this? That's an excellent question. That's why I wanted to stop before we kind of summarize here, because how do you bring these things to your advisor? What are the times that you're thinking that maybe I'm making an emotional decision here? Or what are the things that are actually going on in my life that I need to talk to my advisor about? Think about your life in components. I'm a big framework person. And when I'm doing my own financial planning and I'm working with my family and I'm considering all my healthcare needs and my career, I actually try to compartmentalize my life in some ways. And these are the things that as you're talking to your advisor, you want to make sure that you're sharing with them. One is your family and your relationships. So what are the things that are going on in your life and the things that you're making decisions about? One that I know that came up here where I live in St. Louis, Missouri, was when COVID, the onset of COVID, 40% of the COVID cases were in one nursing home. I had friends scrambling to figure out what to do with mom and dad. Parental care, even before COVID, was one of the number one things that clients could not agree on. Husbands and wives don't agree a lot of times on who's going to take care of mom, who's going to stay home, how are the other kids going to be involved, who's going to pay for it, what is there, what do they want to happen, what does mom and dad want to happen? When you think about those family decisions, think about the things that you're involved with right now, because all of these things have impact. If you're looking at your health and worried about certain things, how do you make sure your family is taken care of? These are conversations that are sometimes hard to even have with your spouse. Your advisor is here to help you with those things. And what about your career? Maybe some of you are thinking about moving out of your job of 10 years before because something's changed in your priorities and you don't want to do that anymore. Or maybe it's either an involuntary decision of what is it that is going to happen in my life? What are the things that I'm worried about as far as my career and being able to still fund my retirement plan? Or maybe it's your lifestyle. My best friend sold her lucrative business here and moved to Texas to be near her kids, something she had never planned to do before COVID. Now her total priorities have changed. Making sure that you're working with your advisor to help him or her understand your top 3 priorities today and the things that are on your plate that you and your family are making decisions about. Then he can help with who needs to be involved in those decisions. How can we facilitate this to have a family conversation? How can we actually create joint priorities while at the same time making sure that each of your individual priorities are also met? This is why I love working with Dearborn&Creggs, because they do these things. They care about the outcomes with your clients. They care about what decisions you're making every day and how they can help and what financial impact they may have over the health of your wealth over time. And as we're thinking about these biases or these behavioral mistakes that we make, overconfidence can make us make decisions too quickly about things because maybe we don't feel the need to do the research. Checking our impulses and bringing in your advisor to run things by them that you may be thinking about is key. Herding, especially now as we see volatility in the markets and what's happening. Don't be one of those who just piles on and leaves the markets. Remember to stick with your plan, to revisit how these things impact your long-term goals over time. And then familiarity. Just because you built wealth with it, or just because you're familiar with it, or if it's a brick and mortar company near you, and you feel comfortable because you know it, doesn't mean that things are always the same with these companies. Look to your professionals here that also can tap into some of the most institutional style managers out there that get lots of information that we as individuals just can't get. The herding, I do see another question here. Let's go here. Should investors expect advisors to reach out to us to make specific recommendations about our portfolios rather than wait for us to ask questions of him and her? Well, here's my response to that. I think it's a two-way street, because sometimes we, as the client, don't understand what our advisor needs to understand, to know about. And sometimes, advisors sometimes assume that you're going to tell us, right? So I think that on your next review with your advisor is, let's talk about it. Go through a rediscovery process with your advisor, because your priorities may have changed. We are going through the greatest reassessment of client priority changes that I've ever seen in the 30-some years that I've been in the business. People are making major life changes and major life decisions. So if you want to have more of a conversation about it, be proactive. And your advisor, if you're not getting that proactiveness from your advisor, tell them. I know the advisors within this firm, and I know that they care about all of you. Now, you may have advisors other places that you may want to talk about what you're doing with them. We're happy to do that as well. But it is a two-way street. And being able to get together with your advisors to set some expectations about what you expect as their client, and for the advisor, your advisor, to tell you what they expect with the things that they really need to hear about what's going on in your life and how you can work together to create a roadmap on your relationship over time. Thank you so much for the question, Josephina. That's a great question. So to wrap us up, and then we'll turn this over to Jana to actually give a couple closing remarks here. I want to end with this slide. And this slide really does talk about the role, kind of to Josephine's question. When you're thinking about the role as an advisor, financial planning, having a plan in place and having a formal plan in place, and understanding where everything that you have is and how it all works together is going to be key. And understanding the information that they need to actually create a comprehensive plan and a roadmap. Understanding the rebalancing strategy that happens to make sure, if you're a balanced investor, that the markets don't just move what you're doing over time, and is something that your advisors do all the time. Let them help you understand how they actually do that, because it's part of the value that they actually bring to you every single year. Tax coordination. Don't hesitate to reach out if you have concerns. Do a 1099 review with your advisor today to see where your capital gains are, to see what's going on. We don't think taxes are going to go any lower anytime soon. I don't think anyone on this call does. So how can you actually look at your tax situation to see if everything that you're doing is as tax smart as it possibly can be, to keep as much of that hard-earned money as you have over time? And then a financial therapist. I like to think about it as behavioral coaching. We do a study every year, every year for the past 8 years, as a matter of fact. And clients, we find that the number one thing that clients appreciate about their advisors is the behavioral coaching that they do based on this behavioral finance stuff that we just talked about, how we make good rational decisions about our investments over time. And then there's your investment advocate of how they're actually bringing together your goals and your circumstances and your preferences for risk and the things that you want to happen within your investment portfolio, and how they tie that to the solutions that they provide to you every single day. And then finally, it's really your financial quarterback of how you can bring in all of this information to them and have a centralized place to talk to them about what's going on with your family and your health and your career and your lifestyle, and even with your community and the things that you're passionate about and the legacy that you want to leave. Bottom line, be aware of those emotions. And once you start understanding the telltale signs of when those emotions are starting to come into play, you can help your spouse with it as well. You can reach out to your advisor. They can help talk through it. Invite other people to the conversation to talk through it. Don't think you have to do this alone. We are here to help you. We work with, Dearborn&Creggs every single day to help bring outcomes to all of you as well. And it's been such a pleasure to be with you today. I wish I could see you all face to face. Hopefully one of these days we can do an in-person one. So Jana, if okay, if you'll come back on camera, and I'll turn this back over to you to close us out.